I'm Liam Card. I'm our firm's Senior Vice President and Portfolio Manager here. Steinberg Wealth. I'm not sure, do we have any BNN watchers here? Anybody watch Business News Network? Okay. If you do, you might recognize our CEO, Lorne Steinberg, who's prominently featured on BNN. He's a market contributor there on what we call the Big Show, which is the 60-minute call-in show. And actually, that's how I learned of Steinberg Wealth for the first time myself. The year was 2011, and Lorne was being featured because the market was down about 11%. He was down 3%. And holding a large cash position at the time. I was so impressed with his approach to value investing that I started to follow him a bit more, to the point where I called him and said, Lorne, you don't know who I am. My name's Liam, and I think we should open a Toronto office, because he was only based in Montreal at the time. So we met, and the office opened. I think we were managing about 160, 170 million at the time, and today we're just shy of $1 billion of assets under management. The firm for me checked off all the boxes, and of course we use a bank-owned custodian, National Bank, so all of our clients have the same level of investor protections as anyone else at TD, RBC, CIBC. So I think before we start to talk about practical solutions to today's volatile markets, and I say today's, but really things have been quite volatile for 5 years now, including a global pandemic, 2 bear markets, and a formal recession. There's been a lot going on in the world, but there's still a lot of uncertainty today. Inflation is front page news. Prices are rising. All you have to do is go to the grocery store or try and travel to know that. Interest rates have risen substantially. Interest rates have risen substantially. Geopolitical risk. I mean, this is something I've had on my presentation for almost 15 years now. High debt levels, whether corporations, governments, or personal, debt levels are high, and with interest rates having risen, that's causing some uncertainty. Political dysfunction. Of course, in the States, I mean, that's just becoming crazy. We've seen all of the drama just to pass the debt ceiling situation. It isn't quite done yet, but it's looking good. And all of these areas of uncertainty, they point to one big question mark. What does that mean for the global economy? Will there be an economic slowdown? Will there be a recession? If there is, will it be short and shallow? Will it be deep and prolonged? So these are the challenges that our investors are facing today. And I think it's just important to go over those before we talk about the solutions. So, you know, I find headlines today are wild. At any moment in time, we're getting bombarded with clickbait. And by clickbait, I mean, you know, the news and the media outlets, they get paid per click. They literally are doing everything they can in the headlines to just try and get you to click. If you do, they win. But unfortunately, when it comes to headlines, it can really affect people's behavior when it comes to investing. Now, here are some examples of some headlines. Stocks could jump 21%. Charts suggest investors should brace themselves for further declines. Why equities are going higher. The stock market rally will prevail as tech shares rebound. Oh, and at least 20% further downside, stock market crash ahead. Does anyone know what all of these headlines have in common? These particular headlines? Anybody hazard a guess?
Fear. Same media.
Fear? Same media. Well, we have Money Week, Business Insider, CNBC. We have a couple of different...
All owned by one media.
Pardon me?
All owned by one media.
Not a bad guess. These are all from the same day. These headlines were all from the same day. So how is an investor supposed to make an informed decision when they're being pulled in every direction by the headlines? And we like to say here that wealth isn't always created or destroyed by investment performance, but by investor behavior. And if you react, if fear and anxiety and panic sets in and you react based on those headlines, what effect can that have from a wealth creation standpoint? And there's no better example of investor behavior than this recent 2020 global pandemic. This was a poll taken in the United States that basically took a look at behavior during the March lows of the pandemic, when the fear and anxiety was at its peak. And this poll found that 24% of investors sold some stock in the March 2020 lows. 19% of people sold all their stock and investments, and 88% of people regretted selling. Now, I don't know what the other 12% are thinking. Having sold, they're happy they sold, I'm not sure, but a poll is a poll. And just all of this points to, of course, terrible decision making. Because what was this moment in time? This moment in time was one of the best buying opportunities of the last 50 years. This is what people were doing. What was our firm doing? We happened to be holding a 30% cash position at the time. And I can tell you it's not because we correctly predicted a global pandemic. We did not. Valuations were high. A number of stocks which we purchased at depressed levels had reached our estimation of fair value. So we had exited those positions and we ended up building a 30% cash position. So when the pandemic hit, we sent a communication out to all of our clients saying, please don't panic. We're holding 30% cash, and here's what we're buying, excitedly buying. So that was a real win for our firm. It was a real win for our clients, and even today we still have clients telling neighbors and friends about that moment in time because it worked out really well. But who did we learn that lesson from? The greatest investor of all time, our friend Mr. Warren Buffett. And he would tell any investor, if he were here, that would have been maybe a lot more interesting than me talking to you this evening, but he would tell you what should investors do during periods of uncertainty? What should investors do when there's panic? Or really just, investing is a lot easier if you follow my two simple rules. Rule number one, don't lose money. And rule number two, don't forget rule number one. Now we laugh and it's funny, and Warren Buffett has this amazing ability to crystallize difficult economic and financial concepts into these simple rules. But really what he's talking about, really what he's saying is focus on high quality, avoid bankruptcies, find the best companies in the world who at a moment in time are trading at a discount to their fair value. And of course, be fearful when others are greedy and greedy when others are fearful. What does that equal? That volatility should be our friend. Volatility should equal opportunity. But the only happy investor when the market falls is the investor with some cash to spend. So you have to pay attention to valuation. You don't have to be fully invested at all times. And March 2020 was a great example of that for our firm. I also find that in moments of panic and uncertainty and volatility, there's a lot of comfort to be had in knowing what you own, okay? If you look at your statement and you see a bunch of mutual funds and you're not sure who's managing those funds and what they hold, all you're seeing is your account value dropping. That's fear-inducing. But if you know what you own, and you know that Visa's not going anywhere, you know that CIBC and TD aren't going anywhere, Manulife's not going anywhere, Google's not going anywhere, Disney's not going anywhere, there's a lot of comfort in knowing that what you hold is extremely high quality and will survive and thrive through the most difficult periods. For us, it's very important that we focus on criteria. Criteria is our discipline. In order to be included in our Canadian equity strategy, our global equity strategy, and even in our fixed income portfolios, we will not deviate from our criteria. We are only looking for the strongest businesses out there who generate free cash flow, And by that, I mean these businesses make more money than it takes to run the business, even after reinvesting back in the business, after capital expenditures. There's free excess cash flow. Companies that generate free cash flow have some wiggle room. They can withstand geopolitical shocks, economic shocks. So there's a lot of comfort, and the sleep at night factor goes up if you're looking at your portfolio and you can identify the high quality of every name that you hold versus just looking at the account value dropping in a moment in time. And of course, monitoring. Things change. Sometimes you have to make sure that the store you bought and the company that you bought is the same as your original thesis. Investors get in a lot of trouble if one of their holdings falls and they just continue to hold it based on hope. Hope is not a strategy. If things change, it's perfectly respectable to take your loss and move on. So, where do we see value and opportunity? I'm just going to run through 4 opportunities we see today. Extremely high quality Canadian dividend paying equities, high quality global equities, investment grade bonds, and high yield bonds. So, I find that Canadian investors love to own Canadian companies because we're familiar with them, right? Like we know these brands, we see them, we use these products and services. Here's an example of our top 10 holdings on the right here. You'd know them all. But I think what's really important, even domestically, is that you make sure that what's under the hood meets the criteria. We have a lot of Canadians who will chase a high dividend yield, for example. They're looking for the highest yielding stocks. They want that high dividend income. Well, you'd be surprised to know that a lot of Canadian companies service that dividend yield by borrowing money. That's not exactly a recipe for success. So all of the companies that are included in our portfolios pay their dividends out of free cash flow. And these little things are important because if you really can't afford the dividend you're paying and things go badly, the dividend gets cut and then the stock falls because people are worried about the company. It's bad. It's a recipe for disaster. So domestically, even if you recognize the companies, make sure that you look under the hood and you see how are you paying your dividend. Are these sustainable rising dividends? Or does this dividend seem a little bit too rich? Could be cut over time. What's the debt of the company? Extremely important. But I will say Canadian equities are exciting today. This is one of the most exciting times to buy Canadian banks. Okay, Silicon Valley Bank collapsed south of the border. That caused a bit of a panic. Canadian banks suffered by proxy, but really have nothing to do with that situation. These are some of the best run businesses in the world, let alone financials, best run businesses in the world with a sustainable rising dividend yield. They're 20 to 30% off today, off their peaks, and a wonderful time to be stepping into Canadian banks, for example. And it's not enough to be well diversified by number of companies. You really should have a foot in many different sectors because in volatile markets, certain sectors will hold up better than others. This is just an example of how our industry breakdown looks today, but we have a foothold in all the key sectors. A shrewd investor in the room might point out the fact that our energy exposure is less than the market. We don't have any energy producers in the portfolio. Believe it or not, we've been able to outperform the TSX, which is the benchmark, with less volatility and no energy producers. So we've just avoided the cyclicalities of energy. We don't want our portfolio to be, do well or poorly based on the price of a barrel of oil. That's something we can't control. We should do our best to focus on businesses where it's a little bit more clear how they make money and it's not, it's not beholden on a commodity. Global equities, our criteria is very similar. We want to see free cash flowing companies with sustainable dividends. We want to buy these businesses at a discount to what we believe them to be worth. This is pure value investing, but quality is king. When fully invested, we want to have about 50 companies in the portfolio. You can see some of the examples in our top 10: Microsoft, Berkshire Hathaway, Disney, Diageo, the world's largest wine and spirits company, Visa, Google. You know these companies. And again, so much quality and comfort when you know what you own, especially in periods of volatility. I would say the big area for opportunity today certainly is in mega cap, high quality tech, where we've seen companies like Disney, their share price fall by 50%, Adobe's pulled back, Microsoft's pulled back, Google's pulled back, Amazon's pulled back. A really interesting time to be stepping into these world's best businesses at a discount. And again, positioning is key. We love Canada, but it's important to know that Canada is just a sliver of the global economy. In this global portfolio, we've got about 60% of the component securities domiciled in the US, but truly some of the world's best businesses are domiciled outside of the US, and we want to be able to take advantage of that as well. So this is the first time in a very long time that I'm standing in front of an audience talking about how excited I am about plain, vanilla, boring bonds. It's been a very long time since we've seen these yields. Investors today in high grade, or they're known as investment grade bonds, investors are getting between 4 to 5% again in a very low volatile, high quality fashion. What I would say is, for anyone who's worried about the volatility out there, and again, these are solutions to volatile markets. If you want to decrease the volatility of your portfolio, add more investment grade bonds, high quality bonds. They are going to act as a volatility dampener, because in periods of panic, a flight to safety happens, which means that people sell their equities to buy bonds, okay? The problem in the past was having a meaningful component piece of the portfolio in these bonds. You were only getting paid about 1%. I mean, you were signing up to lose money against inflation. But now that interest rates have risen, regular boring bonds are back. You can tell I'm excited about it. You should be too. And we're getting 4 to 5% with what is a phenomenal volatility dampener in your portfolio. I would say, just to add to that, you don't have to go out 10 years on a maturity schedule. Shorter duration is better. We run a 1 to 5 year bond ladder for this strategy. We don't think investors need to go out more than 5 years. Okay, so skill testing question. What year do you think it was where we last saw investment grade bonds yielding 5%? What's that?
70s.
The 70s?
Yeah.
Okay. Anybody else?
2002.
2002? 2006. 6. So, you can see that right before the global financial crisis, of course, things have been trending down. During the COVID pandemic in 2020, bond yields basically ground down to 0. And then since then, you can see what's happening, the spike back up as central bankers have tried to fight inflation, incentivizing people to save versus spend. And while the inflation numbers have been sticky, it sure gives us an opportunity in very high quality bonds to get, like I said, 4 to 5%. Now, here's a fixed income strategy that a lot of people don't know about, or if they know about it, it's not well known. It's not a well-known asset class in Canada like it is in the States. High yield bonds. These are simply corporate bonds with a credit rating below BBB-. Today, we're getting about an 8% yield in high yield bonds. So I like to say we're getting equity-like returns in bonds. 8% is perfectly reasonable. Okay, Liam, 8% in bonds, what's the catch? The catch is volatility, okay? Historically, going back to the late 80s, the high yield bond asset class has had about half the volatility of the S&P 500. Okay? So you're getting equity-like returns with half the volatility of US stocks. For a lot of people, that's a great solution to volatile markets. They don't want to wear all the volatility of equities, but they still want that 8% yield. Great solution. In fact, we think that high yield bonds are a terrific complement to any fixed income asset allocation, as long as you've got a proper time horizon and as long as you're okay with the volatility, because the bond prices can be volatile. Like I said, on average, half the volatility of the S&P 500. Worse if it was me. Financial planning. Another really important piece of increasing your sleep at night factor as an investor is having had a retirement analysis or financial plan done. There's a lot of power to be had in knowing your own personal benchmark. And by that I mean we bump into people every single day who may only need a 4 or 5 or 6% return from their investments to meet their lifestyle obligations. But yet when we meet them for the first time and we do an analysis or a proposal or a portfolio review, they're 100% equities. They're taking on way more risk than is required to meet their personal benchmark. And I think the reason for that is most people haven't gone through the process of a financial plan or a retirement analysis to know what their personal benchmark is. But in periods of volatility, there's a lot of power to be had, a lot of comfort to be had in knowing that you're set up properly, your asset allocation and your investment policy statement is specifically geared and tuned to what you need. Sleep at night factor goes up when you know your personal benchmark. How much can I spend in retirement? We've done hundreds, thousands of these retirement analyses and financial plans, and the number one factor is not how much your investments can earn, it's how much you spend. So people want to know, am I spending too much because I'm afraid I'm going to run out of money? Or am I spending too little and maybe I could take that extra vacation or drive a nicer car or give money to family members, or like early gifting is a really big thing now. This answers that question. People want to know that they're not spending too much in retirement because nobody wants to be a burden on their kids. Again, like questions like how much can I leave to a charity if that's important to you, leaving a legacy, if you want an early gift to your children, or in your will, gift to your children or charities. It's important to know that if you have a number in mind of what you'd like to gift, we should probably be talking about what it's going to take to get there from a spending perspective, what your investments have to do for you in order to meet that milestone. So just to recap the practical solutions to the volatility we've been seeing over the past 3 years, even 5 years. If you want to reduce volatility, please introduce some high quality, plain vanilla investment grade bonds into the mix. You're going to be receiving a 4 to 5% yield, and if volatility increases, if there's a geopolitical shock, if there's a recession, it's this part of the portfolio that's going to hold up incredibly well for you. Know what you own. You know, like I said, there's a lot of comfort in quality, and if anyone in here isn't sure what they own, or when they look at their statement, they just see a bunch of different mutual funds, we would be pleased to meet with you. We'd be pleased to do a portfolio review and analysis and tell you what you own. And there's probably going to be a lot of, that's a powerful thing to just say, okay, you know, I wasn't sure what was in these mutual funds, or I wasn't sure the names of these companies that I see in my statements. We'll tell you. Know your personal benchmark, and if you don't, come and see us. We'll be happy to go through the process, and the result of that meeting will be you knowing what you need to be achieving over time to maintain your lifestyle. Buy low and sell high. We have figured it out, ladies and gentlemen. That's what we should be doing as investment managers. One way that you can guarantee that is certain assets will do better. Certain asset classes will do better at moments in time. So if stocks have run up, trim them back to their target allocation, take the proceeds and buy bonds or a different asset class that may have gone down. That guarantees that you'll be selling high and buying low. Avoid those knee-jerk reactions to the headlines, please. And my bonus solution as I wrap up the presentation is reducing management fees equals wealth creation. On average, we just continue to come across people paying 2%. They're paying their advisor 1 plus the mutual fund company 1. 1 plus 1 still equals 2. If you can reduce your fee, and on average we reduce clients' fees by, I would say, 40%, sometimes by half, that just equals wealth creation over time. And if you're not sure what you're paying in fees, come and see us, and with no obligation, we'll tell you what you're paying in fees. In front of you is a little contact card, and we would love to hear your thoughts. If you have any feedback, if you'd like to subscribe to our complimentary newsletter, if you're interested in a portfolio review or a financial plan or retirement analysis, please let us know. My wonderful colleagues, Fraser and Michelle, will collect the cards and we'll follow up with you if you have questions. But that concludes my presentation, and thank you so much.